Hello and welcome to NDTV Profit. You are watching The Portfolio Manager, and my guest today is Deepak Shenoy, who is the founder of Capital Mind. Deepak, thank you very much for joining us on The Portfolio Manager. To begin with, Deepak, we just got over with the earnings season third quarter. I want to begin with your thoughts on how the earnings has shaped up in the third quarter and how do you see going forward?
So it's actually quite interesting. We've seen, in fact, a lot of mid and small caps announce fairly good results. Some of the large caps as well, but overall, I think large cap earnings have moderated a little bit, largely because some big players like SBI and some of the banks have relatively muted results in comparison with what was last year. So the financials have been a little bit of a letdown, little bit, but not all of them. However, we're seeing the some of the domestic stories show considerable interest, so considerable movement in both earnings, revenues, and commentary from management. So overall, quite happy with this result. Though I would have said that I probably expected that it would be a slightly better quarter because it's the Diwali quarter. It's not been as rewarding as one would have thought, though it's still good compared to last year.
What do you think are the pain points going into Q4 and maybe into next year, because you have an election coming in, you have you have couple of two wars on the backdrop. There is supply chain issue tightness which is coming in, and liquidity issue which is also coming in into the market. How do you assess the Q4 for some of the companies, and how do you go into FY25 with these factors in play?
No, I think where we are right now is a very interesting point. I think a lot of this problem or pain points come in margin compression in some industries. So we're seeing pharma, some of the chemicals industries show that in their results. We're seeing the banks and the financials show lower PAT because of higher provisioning requirements by RBI that came in the last part of the last maybe 2 months of the previous year. And also because in general, you have a catch up in terms of liabilities repricing themselves upwards. The deposit prices, deposit cost has gone up. Even today, for instance, we saw 75,000 crore reverse repo, a repo, apart from a 1,75,000 crore repo that's already been in progress. So the market is essentially demanding money from RBI. The banks are. So they've gone from a liquidity surplus situation to a liquidity deficit situation, and the cost of funds has therefore increased across the board for financials. Just not now, but it started the previous quarter. So a bit of pain there. I see, however, a lot of interesting moves. So, for instance, government tax collections are very buoyant. There is therefore a feeling that next year the deficit is. I mean, of course, in the budget also they talked about it. The deficit is going to be substantially lower than expected. So they don't have, a lot of bonds that are coming to issue, and then India's bonds, government bonds, get added to global indexes. So we're going to see a little bit of a reduction in the cost of funds or the available supply of bonds from the Indian government. So I think government bond prices will go up, yields will come down. However, because of the liquidity deficit, I expect FD rates to stay where they are or increase from here a little bit. So we're going to see that change from the financials. But I do think that a lot of this money that the government has been collecting, that's going to go significantly into domestic infrastructure spending, domestic energy consumption, energy independence, commissioning of maybe a bunch of more alternative energy. So whether it is nuclear or whether it is a push higher on EV, a scale change in terms of fuel or import substitution in a way, building in more semiconductor, doing PLI and semiconductors, doing PLI on domestic manufacturing in general. I think that gives the government more scope to do that. So there will be, I think, a marked increase in activity for domestic manufacturers, specifically in the infrastructure sector, the machinery sector, in B2B commerce, and perhaps later down the road in domestic consumption as well. Exports are not likely to do that well. So IT is one, but a bunch of others as well. I don't think that's going to be a very big demand zone for the world. It's simply because the world's going through turmoil right now in different ways. America is talking about, of course, America is doing very well, but the economies there are grappling with tech layoffs and unemployment in general. There is also the fear that the Fed will not cut rates, so there is perhaps relatively high rates to stay. Europe is and China are going through crisis in the debt areas. So I don't think we should bank on exports for the coming year or so. But there will be a time to buy exporters, just not now. I think the rest of it, we have a bunch of themes in our portfolio, in one of the portfolios that we manage, where we actually target make for India, not just make in India. So it is essentially the manufacturers, the import substitution concepts, and so on.
Uh, I was looking at some of your portfolios, primarily Surge India, which is there. I think that's what you're talking about, referring to, I think. And then you have the Adaptive Momentum portfolio, which is a totally different kind of philosophy which you use for that portfolio. How do you go about constructing such a portfolio given this kind of thing? Because if I can see, industrial manufacturing accounted for nearly 25.9% of the portfolio. That's a huge. You're betting a big on industrial manufacturing, more than 1/4 of your portfolio on that. So what makes you so bullish on that?
There is actually, like I said, the PLI, the government ability to push this, the fact that India manufactures very little for itself. I'm not saying for sending abroad. This is the typical fear that people have is, oh, India will manufacture, but how will it compete with China? But no, India can compete with China for manufacturing for its own citizens. Whether it is from clothes to some of the best quality clothes are manufactured in India, sent abroad, and then we re-import them and pay the higher prices for them. So there's no major level Indian brand that has taken place in a lot of areas, whether it is from food to clothing to footwear. Our brands are relatively small, so I think that part will change over the next few years, and the domestic manufacturing is a part of it. So to make larger amounts of everything, you're going to need machinery, you're going to need a lot of core high-end stuff. So for instance, the railway push, the big push in metros, a lot of the equipment is being built by Indian companies for the Indian railways and for the various metro projects. This is actually going to be big for us. That's what I mean. We feel that that's the manufacturing piece is going to be huge in the next 5 years.
But many of these companies have run up significantly in the last 12 to 18 months. Do you still continue to consolidate your holding in this, or you'll add further because the PLI play is not just for 1 year; it's going to play out for at least 4 to 5 years for these companies. So how will you play that segment?
Yeah, the PLI thing is a temporary piece for us in the sense that you just get them to a point where they scale, right, and then they can command their prices anyways. I would say that is the first layer of thing that's part of the process. While yes, prices have run up, but sometimes prices, they don't necessarily reflect long-term realities even after they've run up. So you've seen this whether it was at some level when the move happened to renewables in a big way. You saw a lot of the public sector power finance companies that ran up quite considerably. So some part of that, for instance, was captured in our momentum portfolio. But these companies today also are not super expensive. They're 8 times earnings. They're probably one-time book. Many of these companies, although they have to demonstrate their potential, the expense is not, it's not as expensive as one might think it is. Another set of cases in defense, there are lots of players where I think while we've had a run up in the stock price, the earnings growth is going to be so significantly large that we're going to talk 2x, 3x, 4x times earnings in the next 3 or 4 years itself, which gives more opportunity for the stock regardless of whether it has run up in the past.
Can you take the entire defense sector as a whole, or you will need to segmentize the sector because each company has a different niche, and the order book. So if you look at from a holistic or top-down approach, they may show 2 years, 3 years order book with them, but it is very how do I put it? It's going to be very chunky revenues which are coming in. We saw some kind of that happening in the Q3 with some of the defense companies where revenues and profitability miss the targets. Over a period of time, yes, that will translate into a revenue, but when you look at quarter to quarter, maybe you need to look at a different through a different lens for these companies.
Yeah, the quarters are not relevant. I think the idea here is how's the business. Every quarter is just a more a media concept, right? So you every quarter we have to look at the results, trying to come to a conclusion that this company is good. I don't think the quarterly results matter as much. While you look at them to see whether they're on track, by and large, the longer term story is what matters. I don't believe here that you're going to build yourself into a point where a single quarter is going to change the trajectory of a company completely unless something major happens. Usually some of these quarters will be like preparing for stuff. The orders in defense, for instance, especially if it's coming from different parts of the ministries and different parts of the military bureaucracy, I think you'll find that a lot of orders start flowing in much after some of the concepts or some of the things have been talked about. So you will find that they're chunky towards the end. That means maybe 3 years from now, these orders will come into fruition. But then you're not investing for tomorrow and day after. You're not investing for one quarter. You're investing for a long term. So you're going to wait till those things come in. And then you know that the defense sector itself is going to ask for more. So as we go along, it'd be like, oh, we've got, let's say it's a drone manufacturing for the defense. So you might have kamikaze drones. You might have drones that survey and come back. You may have drones that are high level and so on. But then they won't all come at the same time. It'll be the first set of drones that will be given an order initially, and then they will say, okay, from this we want a bunch of other stuff, technology that tracks them, technology that does something. You'll have satellite level defense technology also, so a bunch of other companies come into play. So there is actually, I don't think this is a quarter by quarter thing. This is more a long term trend. And what we've done so far is always bought technology from foreign companies and told them, listen, you need to set up some local manufacturers to manufacturing to kind of support us. But now they're saying, no, let's kind of give some of these contracts straight away to Indian companies. Let them, Indian companies, partner with whoever they think is the right person and bring in the technology so that we get a lot more of the pie. I think that is going to really dramatically increase. It's happening in railways as well, where we may be importing some bogies from China or from some technology from Germany. But even in the end, the project's actually managed entirely by companies in India. They are doing the partnerships, they're building the maintenance, they'll probably take part of the growth. So today, a set of bogies may come from China, tomorrow, the next set of bogies may come from India, and not have to depend on exports. And the domestic companies that are listed, they're the ones that will benefit. I think that is the scale we're talking about here. We have never seen this in the past. It's always been relatively small. Defense itself has not got its capex fully utilized for a long time. But for the first time, you've seen that the government coffers are full, they're able to spend. And I think infrastructure, railways, logistics, these are the areas that I think dramatic improvements are on the way.
Deepak, let's look at your momentum portfolio, adaptive momentum portfolio. It forms one of the largest schemes in your PMS. How do you go about constructing a momentum portfolio in this time? Because we have seen a lot of run-up happening in many of the sectors, stocks and sectors. So how do you decide on stocks?
So the concept of a momentum portfolio doesn't matter what time it is. The idea is to that simple concept is stocks that go up on average keep going up. That means when they go down, you must sell them. They're no longer part of your portfolio. Give it a certain amount of time because obviously you can't do this on an hourly, daily, or even weekly basis. We do it now on a monthly basis in the PMS roughly. So that means every month is a small rebalance. In that rebalance, we kind of move out stocks that are not on top of our ranks in terms, it's an algorithmically ranked portfolio. So you use quantitative factors, simply price and volume, to find out which stocks have relatively smoother and longer term momentum. And the ability for us to kind of use that, and we've coded it into an algorithm that allows us to see what stocks meet our criteria and are the top level. We rank all stocks in this, and then we take the positions on them. Whatever stocks, sometimes we've seen stocks last even a year in this portfolio. Sometimes the stocks will come in and go, but that's the idea here, is when you win, you should win so much that it makes up for times when you lose, because momentum always has elements where some stocks will show some momentum, and then that momentum will die soon, right? So you have to exit those stocks. So the idea is cut your losers quickly and let your winners run.
How do you select those kind of stocks? Because do you use fundamental in some way to look
No,
at the stocks, or is purely run up? And are you able to catch the stocks before they run up?
we don't have to catch the stock before that. That's the idea of momentum, is they have to catch the stocks while they're running, not before. You don't catch bottoms, you don't try to catch tops. They let the algorithm filter out what has momentum, and then you see we've gotten to PFC, for instance, last year, and it is up 4x, so 3.5 times from the time we got it. You might look at us and say, well, you didn't get in at the bottom, but that's fine. If you're still making 4 times in a stock, that makes up for a lot of small stocks where you would have lost 10, 15% because they lost momentum. So the idea is never to get in at the bottom, and it's not human selected, right? So it's algorithm selected. You don't use fundamentals. You use only the price, and then you filter out for low volume stocks. So you're not going to enter a 100 crore, 500 crore, 1000 crore stock. In fact, because of our volume, we run about 800 crores in the portfolio, roughly 20 positions. So you don't want to enter a stock that does not have the liquidity to be able to take a position of our size. So most likely we're choosing among the top 200, 250 stocks in the first place in terms of volume. So you're only going to be largely going to be large or mid cap at the core of it. Though right now we have seen some small caps actually come into the portfolio because there is enough interest in them that makes them available to us at sometimes they have volumes of 100, 200 crores a day, even in the small cap level. So they fit our criteria, saying, listen, we can enter and we can exit. The idea of not using timing for this in terms of human generated timing is almost like saying, we do not know when this momentum will end. Nobody knows. I got 6 months ago people calling me and saying it might be over now. The market has run up. I said I don't know, and it's up 35% in 6 months, or 40% in 6 months. And if you had gotten out at that time or tried to say that the market has reached a top, that would be unnecessarily harmful to long-term returns. You have to make the big upsides, otherwise you will not make great returns.
Do you consider some of the PSU banks that have run up as part of this momentum portfolio?
If they're getting selected, they'll come in. They have come in the past. Right now, I think the volumes they're not enough numbers in there for us to say that there are PSU banks. I think right now there's probably very few in there that would even qualify in the whole financial sector. Though they were there in the past, so it's not like this. They've never been there. But right now they're very less. We don't have any. I don't think we have any. Bank right now in the momentum portfolio.
What role does liquidity play in this actually? Because we mentioned that some of the small caps have also run up, and now you are getting queries for some of them. But biggest issue with some of the small caps has been liquidity, right? They run up and then suddenly you see that liquidity drying up.
Yeah, I'll give you an example. Yes, it was Yes Bank, a small cap. A few months back, it was Yes Bank having liquidity? Answer was it was trading more than 120 crores a day. So if it had qualified, it would have come into our portfolio. Sometimes PFC and REC were mid caps when they got into our portfolio. Now they're large caps. So I think liquidity has different faces. So we don't try to say that small caps don't have liquidity. We let the volumes suggest. So if the average volumes of maybe 10 days or 20 days are actually, or median volumes are actually high enough, that's good enough for us to say, well, there's enough liquidity in the stock. So that's we have very high filters for liquidity. So almost never do we trade a stock which is too small and will not have enough liquidity. So, those uh, we at our volumes, at our size, simply can't do it.
What would be your top 4 or 5 stocks in this momentum portfolio? Given that you do a lot of rejig on a monthly basis, what would be the top 4 or 5?
Yeah, right now it, for instance, still remains REC and PFC because they haven't lost meaningful momentum yet, and till January end they were doing very well. So we do have some others. There's a few smaller companies. For instance, I think on the large side we've even had a trend. On the relatively small side, no, now it's reasonably large. Is still BSC, which has some meaningful volumes. For instance, there are stocks like this that have come in. Some of them are actually fundamentally good. BSC, for instance, also is there in our Surge India portfolio. Trend is also a very fairly good stock. LIC is very interesting. It's just started to appear in our momentum portfolio as well. So it's early days in terms of this thing. But I think right now, what the positions are, if you ask me a month later, it would be very different because when the next reshuffle happens, it's quite likely that the top positions may change.
Deepak, it has been a pleasure talking to you today, and especially talking about your two portfolio schemes, adaptive momentum portfolio and Surge. Thank you very much for joining us on the Portfolio Manager and being on NDTV Profit. You were watching the NDTV Profit, and that was the Portfolio Manager with Deepak Shenoy of Capital Minds. Thank you for watching.